there.
Hey everybody.
So today we are talking entity structure that could be a situation that is potentially costing you thousands of dollars in taxes.
Great topic.
It is.
Especially considering the time of year.
Yeah, it is. So, quick thing. If you're a business owner, you are basically one of four types of entities. You're either a sole proprietorship, a partnership, an S corporation, or a C corporation. That's it. There's only those four. So normally when you first start out, you're pretty much a sole proprietorship. And that is basically the taxation on that is everything is taxable.
No.
No, I'm kidding. But anyway, so we have these four particular entities that are recognized for tax purposes. But I know that there are people out there saying, no, there's not, Becky, you forgot one.
Not the LLC.
And although you're correct.
Yeah, the LLC is not necessarily the way that you would be taxed. An LLC is similar to a corporation in the fact that it's really for protection purposes. It acts as an umbrella. But for taxation purposes, you are only one of the other four.
Right. So that LLC is just an added layer of protection for the owners and the members, honestly. And so, because everybody's usually, well, I'm an LLC, and they're like so proud of that. I don't understand what that is. But an LLC is not a tax entity, right? So you're only looking at the other four as far as being how you're taxed at the federal and state level, and the LLC is just an added layer.
That's what the IRS recognizes, that's all. So the LLC is strictly on the state level.
Okay, so back to the taxability of how your entity can be causing you to be paying an extra thousands and thousands of dollars. Is we just want to let you kind of rehash just a little bit with regard to how the four entities that we just discussed are actually taxed, like what you're looking at as far as profits at the end of the day.
Yeah, absolutely. So the sole proprietorship is the most common. A lot of people, when they first start out, they're going to be a sole proprietorship because they haven't really earned enough money to deal with everything that's associated with a corporation.
And it's easy to set up.
It's easy to set up, and until you get a direction as to how much money you're going to make, so that's probably the default or the best entity to start with. Now, if you know how much you're going to make coming out of the box, then obviously if a corporation is more suitable, we would discuss that with our clients. But a sole proprietorship, more or less, income comes in, you have your expenses. Anything that shows in a form of a profit, that's subject to taxes, so federal, potentially state, not in Florida, but in any other state. Well, most other states.
Not any other state. It really depends on the state you're living in.
But the issue that people get into trouble with is you have the Social Security component, the FICA tax. So not only are you paying federal, potentially state, but then you have the Social Security or FICA tax.
And I think myself, that is the tax of death. It literally can bury a company.
That's what gets most people in trouble.
It sure does.
So
it sure does.
They think they made a certain dollar amount and there's no money in the bank, and all of a sudden they have this big tax because they owe the tax, and the FICA tax sneaks up on them. And so it's a lot more. It's a higher scenario. Usually the taxation on sole proprietorships is higher.
Right, and most people are, in their mind, tax planning for just the federal and state tax. They forget about that Social Security tax. And because, when you earn a paycheck, that's coming out automatically. And when you're a sole proprietorship and or a partnership. So a partnership and a sole proprietorship are very, very similar in the way they are taxed, because partnership is basically two sole proprietors or more that have gotten together. Okay, again, very easy to form. A partnership does have lots of pros, but it also has cons in the way of its taxability. So same thing happens in a partnership. And then what we find is typically, especially if we're not your BFF CPA planning you through all of this, is that we find that these people, you prepare the tax return, you say, here you go, here's your tax liability. And they're like, I don't have that money. Where is that money? I don't have that. And now it's due on April 15th. And so is the first quarter estimate
estimated tax payment that
for-
should go down.
for the following year. So now it's double whammy. So that's the taxation of sole proprietorship and partnership. Now, a partnership is a flow through, okay? So a partnership has its own separate tax return, but the profit does come over onto the personal return. As with an S corporation, an S corporation's taxability is whereby the profit itself that's left over is taxable to the partners on their individual income tax returns at their federal and or state tax rates. Okay, no self-employment tax.
That's correct. Now, as a S corp, that's a shareholder, not a partner. On a
I'm sorry,
partnership,
right.
the K1 would be a partner. K1.
Correct.
So.
Did I say that? I'm sorry.
Yeah. So now with the shareholder.
I get like all excited.
Well, it's a lot.
I just
when you talk
dork
about all
out.
these different entities,
I know.
it's hard to
I
explain
dork
and also
out.
hard to follow.
Are you guys taking notes? Take notes.
So with the S corp, it's similar to a partnership. A Schedule K1 comes through for the profit of the business. The issue with S corps is that you do need to take a payroll. You need to take ample payroll for whatever job function that you are, in essence, doing for the business. So, separate entity, the taxation flows through any profit, but you do need to take some kind of payroll.
Right, which would render you getting a W-2 like you normally would from any other job. So within that W-2 now, you're paying the FICA tax, right? But the company is matching that. So it's not all essentially out of the money that you're taking. So we're going to go through a detailed example for you with actual numbers so this all kind of makes sense. But just know that the profit that comes over from that S corporation onto your personal return is not subject to the self-employment tax, which is a huge tax savings. And then last but not least is a C corp.
C corp. So a C corp is where a lot of people get in trouble as well. It has its own nuances. It definitely has its place, but it's its own separate entity. Obviously, has the protection associated with being a corporation. The difference with that is you have to be on payroll, and the profit is taxed at the corporate level. So, and based on the Affordable Care Act, it's a 21% across the board for the corporate tax rate.
So I have to jump in because that's huge.
Oh, that's tremendous.
That is huge. It used to be a scale like your personal return is, and it was, I think it was like the first 50,000 was taxed at 15%, and then
18,
it went up from there,
21,
right?
23.
So it was. I mean, if you were staying under 50,000, that 15%, that 15% tax rate was very palatable. But if you're over the 50,000, then it starts scaling up. However, that 21% is pretty cool essentially because if you're a corporation earning $150,000 to $200,000 profit, that's a significant savings in and of itself. But I mean, there are other items associated with a C corp. Just because that profit doesn't come over to you personally, you are still going to get taxed on the dividends.
Yeah, in other words, in some cases, and in a lot of cases actually, people who take distributions from the C corp, they're getting hit with dividends. So now you're paying taxes on the dividend that you're receiving, plus the business already paid a tax at the corporate level. So that's where you get into the term that you hear commonly about double taxation.
Right. So you paid the tax on the profit at the corporate level at 21%. Now you take that profit out, you're paying tax again as a dividend. Conversely, with an S corporation, whatever that profit is, you're allowed to take that out tax-free. So there's yet another layer of additional taxes. So I know this sounds crazy. There's so many different things happening right now. So what we wanted to do was share with you an actual tax plan that we did for a sole proprietorship that came to us because they're new. They weren't ours from the beginning. Why is because if they were ours from the beginning, they would never have been in this scenario. But anyway, we ran numbers for them just to compare and contrast each entity and the actual out-of-pocket tax dollars that would have occurred had they not been a sole proprietorship. So they are a sole proprietorship, and their profit for the year was $112,000. Okay, and so when we did Eric's got our spreadsheet up because it's just too many numbers for us to actually memorize and sit here with you and discuss quickly. So, anyway, under the sole proprietorship on $112,000 of profit, you're looking at the federal tax, you're looking at the Social Security tax, okay, and the matching portion. We didn't factor in state because the state tax rate varies depending on where you are. So we didn't even factor that in. But nonetheless, on $112,000, we're looking at about $21,000 in federal tax, and then about $15,000 or $16,000 for the self-employment tax. So basically, you're looking at $35,000. Writing a check for $35,000 at the end of tax season if you had not made any estimated tax payments, right? So then we popped over, and by the way, so I'm sure that you've heard of obviously the Tax Act that everybody's freaking out over. So we included in that the Section 199A deduction. So everything's in there. It's like the whole recipe together. Just so you know. That probably means nothing to you, but in my dork world, it was a $16,000 deduction. There you go. Anyway, so you want to share with them the differential with an S corporation taking that same 112. So what we did was we took the same $112,000 profit and we broke that component out, because if you're an S corp, as Eric indicated, you have to take ample salary, which is an entire discussion for another day, okay? Because it's gray, very gray area. But we used $48,000 salary.
Yep. So that's what we did. We used a $48,000 salary, and we have the income on the business level. Profit was $63,000, or almost $64,000.
S.
Oh.
Yeah, you're good.
Okay.
Sorry
about that.
No, you're good.
So then when we take the deduction for Section 199A...
Wait, let me just interrupt you one sec.
Go ahead.
That $48,000, where Eric's coming up with the actual business income being 63, it's the 112 minus the 48 is what you're left with for a profit now that's taxable versus the full 112, because you already paid some now on the $48,000 salary. So what you're left with is the 63. Sorry.
Yeah, no, that's perfectly fine. Correct me anytime.
I'm gonna say that out loud.
So now the deduction for the Section 199A, there's a reduction of $12,000. So the $63,000 was brought down by $12,000. So taxable income was reduced by that amount. So then, based on that, the FICA withholding from the salary was $3,600. And then we have the federal income tax was $21,000. And then what we have here is the total tax was $25,000.
Right, but we had the matching portion.
So now we add in the matching portion that was withheld from wages was the $36,000. So that comes to $29,000. So $29,000 is the overall tax that was owed on the individual level, because again, at the S corp passes through to the person on the individual level.
Right, on that same $112,000.
Yeah, so that reflects a $6,000 tax savings from being a S corp versus it being a sole proprietorship in this particular case.
So the sole proprietorship, obviously, what is that? That is about a 20%.
Yeah. So the effective tax rate was 31%, went down to 26%.
We're 26%. So we grabbed 5 points for nothing, for being an S corp taking some payroll. So with a C corp, that same number, $48,000 in salary, $63,000 in profit at the 21% tax rate, factoring in the FICA tax that you paid on your salary, okay, and that we're not paying on the 63. I'm sorry. However, as we indicated earlier, if we were to take that 63 out in dividends, because it's our money, right? We're going to pay tax at the corporate level on the 63 times 21% tax rate, all right? Then we're going to take that money out of the company because it's ours, and we're going to pay ourselves that dividend. We're going to put it on our personal return as a dividend and pay tax again. Thus, that double taxation. That cost us $45,000 $45,000 in taxes. $45,000. So in this scenario, a C corp is not the way to go for our client, because our client wants to take their money out. Okay.
So that's exactly the point. That's where people get into trouble, is that they are a C corp and they just take all the money out of the business, and then they end up paying more in taxes. The benefit of a C corp, obviously, in this analogy, would be that the money is retained in the business and used for, capitalization needs, other types of things, fringe benefits, additional payroll, anything but
taking it out in dividends. Yeah. Whereas in that S corporation, you're paying tax on that profit of $63,000 at the personal level. Therefore, when you pull it out, it's your money. Mm-hmm. It's not double taxed again. Yeah. In most, granted, okay. I gotta do that thing, what is that thing where you're when you do weight loss programs, they don't guarantee specific weight loss numbers. There's always a what if, and something that's going to contradict what I said. I'm not speaking in totality, I'm speaking in the norm. Okay. Yeah. Obviously there are situations where an S corp actually pays dividends and is taxable, blah blah blah, but we're talking about just the norm, the general norm of what we see on a 95% level every single time. So
yeah, everybody's situation is different.
Of course.
So you just have to make sure that you're either meeting with your accountant, making sure that you're the right type of entity. Obviously we're more than happy to help you as well. But this is the kind of stuff that really needs to be addressed, because then even once you kind of understand about how everything's taxable, strategy comes into play as to whether to convert from one business entity to another, and when, and even at that point, multiple types of business entities where there's a C corporation working in conjunction with an S corporation. So there's all kinds of strategy that needs to be discussed.
And the thing is we're looking at right here, we went from 29,000 at the best case scenario up to 45,000. That is a huge tax gap right there, right? So huge increase in taxes if you're the wrong entity. And normally, as Eric said, if this person were our client and we started to see on a monthly basis doing what we do with our monthly clients in our essentials package
we have monthly programs
that we offer, is that we're looking at this type of stuff, if you will, and if that's coming across our desk, we're going to have that conversation before it gets to $112,000 of profit that has not had tax paid on it, number one, or number two, has had no salary or needs that entity shift. And so a lot of what happens throughout a monthly client or you being a sole proprietorship or anyone in business not seeing their accountant can cost you that kind of tax dollars. That's a $16,000 spread over 5 years. If you do that for 5 years, that's assuming your revenue doesn't go up and your profit doesn't go up, which in 5 years it really should. So it's even more than that. You're looking at probably in excess of $100,000 in taxes thrown out for the past 5 years, right? That you want to get back in your prospective years with the correct tax planning. And so I'm not saying that it's always easy to go from a sole proprietorship to an S, or an S to a C, or a C to an S, or a partnership in there, because you certainly have to have someone in your corner, in your back corner, telling you the taxability of switching an entity, because that can happen. Going from a C to an S, or an S to a C with assets involved can certainly render a taxable event. And you have to decide, you have to plan through that and decide if that strategy is going to save you how many times that going forward, right? And so that's a discussion with your BFF CPA.
Yeah, you have to run the numbers.
Of
so
course.
There's no doubt that switching from one entity to another, even using the analogies that we're talking about, everybody's situation is different, and so the numbers need to be run individually. So you definitely need to speak to somebody about this, and and we would love to have you come on board with us.
Yeah,
I have to pitch you.
Of course. 'Cause you get both of us. You just don't get one; you get both of us, right? Yeah. But I will say, this right here is a very large situation that we deal with new business owners that have been in business 3 to 5 years, and maybe they just started out. Because most of the time with us, we will suggest you start out as a sole proprietorship, like Eric said, unless you come and you say, look, I have a contract that says that I'm going to earn $500,000 this year, or I'm going to earn $250,000 this year, or maybe you're in an industry where it doesn't make sense to be a sole proprietorship right out of the gates because of the liability. All right, so there's different scenarios, but the case in point is that we are chronically looking at that, and then as different events come up in a business owner's life, like maybe it's, okay, we started the business and we're paying rent somewhere, but now we want to acquire a building. Okay, well, we're not usually going to acquire a building in the same business entity structure because that could be detrimental. Also, there's additional liability associated with that. So there's different reasons for different entities being switched.
Segregation of assets.
Right, exactly. And this is why this particular topic can be so costly to a business owner if it's not done correctly and with the guidance of a CFO, a CPA, or someone in the industry that fully understands this. So I urge you not to be penny wise and dollar foolish. I'm telling you, there's thousands of dollars on the table right now that you probably don't even know about, that you're spending in tax dollars that you probably don't need to.
Yeah, a lot of people they hide from their accountant because they feel every time they speak to them that they have to do something, and they say, oh, they have that, but it's more than that. It's not just entity issues. It's different tax strategies. It's understanding where the growth of the business needs to go. There's just so much more that's involved with you having your accountant or your CFO help you, build your business, make it grow, and you can't hold back on that kind of thing. You can't try to do it yourself.
Yeah, but
in the end, it's all about the numbers, really.
And they can't hide from us.
Yeah, we call out clients when they don't listen.
Yeah, I mean we do. It's
nicely
it's real.
at first, but sometimes we get mad.
Yeah, sometimes we go Rhode Island, as I like to put it, on them. But nonetheless, certainly if you do have questions, I mean, we're obviously here to help. That's why we put this information out there, is so that it just starts you thinking. If you're not already thinking about this, to have those conversations with your BFF CPA or your CFO or who is ever in your world that can help with this, okay? And then if you don't have anyone, of course, we are happy to help. We're here. We're on the other end of the phone. We are... DM us, email us, get on our website, and contact us. We're available. We're ready on the other end of the phone with you just to have a conversation, to even see if you have an issue or if we're compatible to work with. And that's basically it. I mean, I don't know. I think that if somebody brought to my attention $6,000 to $16,000 in tax savings, my eyes are going to open up.
That's just one little strategy.
That's just one strategy.
There's 68 different types of strategies that we are very familiar with, and you can help see if they're applicable to you.
And most people can take advantage of about 35 of those strategies. Yeah. The others, the 32-ish.
Unique circumstances.
Not necessarily unique, but they're...
Takes time to plan.
They're less likely to be common. Let's just say that. They're not the everyday run-of-the-mill ones. They're great strategies, especially for business owners, that you can utilize. And that exactly what you said. It takes time and energy for tax planning. It can't be a last minute. I mean, some of the things are last minute things that you can do, but after December 31st, your tax planning starts for the following year. So, anyway, usually, yes, it does. It starts going forward.
For calendar-based people, anybody who has a staggered year end, it's different.
It's different. You're absolutely correct. All right. Well, we're going to sign off. We thank you for joining us today. If this helped you, please let us know. And if you think it served you or can serve someone else, we would be super happy if you would share.
All right.
Have a great day.
Hope you got something from it.
See you later.